Hello everyone and welcome to this lecture on Cost of Capital chapter 12. Now this is a chapter you need to listen to before you work on chapters 9, 10 and 11 because 9, 10 and 11 keep referring to cost of capital as the cutoff rate. So what exactly is cost of capital? Cost of capital is the rate of return required by investors in the firm's securities. Now it sounds like a very simple definition. Is it really all that simple? Actually, it is. Let us say a firm has issued bonds of, say, 10,000. And after tax, and bonds are the only thing taken after tax, it costs the firm 6% after tax. So that means $600 a year per year. Now the firm, of course, these are market values. Then the firm has preferred stock. That's supposed to be an E, by the way, 20,000. Let us say preferred stock costs this firm 8%, 1,600, I think. Okay, now then they have retained earnings or internal equity or external equity. Well, let us just call it equity for now because we are just understanding the concept. We'll come to internal and external later. Equity of, say, 30,000. Now let us say the cost of equity is 10%, which is pretty reasonable for this company. So totally to keep $60,000 that the investors have provided, company is paying $5,200, I think. Is that right? $5,200. And remember, the only thing they took after tax is debt. Debt is the only thing they take after tax. Now, going back to this, the cost of capital for this firm would be $5,200 divided by 60,000. Now how much would that come to? Let's check it out. 5,200 divided by 60,000 multiplied by 100. 8.67. Now this is known as overall weighted average cost of capital, or I think in this textbook they call it KA. Now the textbook also recommends you can do it another way. Like for example, you can take the weights of these and multiply them with the percentages. Like for example, what are the weights? The weight of bonds would be, say, 10,000 divided by 60,000, which would make it what? Let's see. 10 divided by 60 is 0.17 is the weight of bonds. Then weight of preferred would be 20,000 divided by 60,000, which is kind of like 33%. 20 by 60 is 0.33, and the weight of equity would be 30,000 divided by 60,000, which is 0.5. Now, if you take these are the weights, okay? That means what one is as percentage of the total. Now you can use this another way to calculate cost of capital. You can take 0.17 multiplied by 0.06, which is a part of the bonds. Now plus 0.33 multiplied by let's do this way. It's easier that way. We don't have to reconvert it. Okay, let's go back here. 6%. This is 8% plus 0.5 multiplied by 10%. Weight multiplied by the cost. Now, in case of debt, it's the after-tax cost. So, what is 1/6 of 6? 0.17 into 6 equals 1.02. 1.02. Then the next one is 0.33 multiplied by 8. It's 2.64. And this is, of course, 5. Now you take 66, 8.66. Well, it should be 8.67 rounding up. I mean, the answer that you get here is the same as the answer you get here. You can do it either way. I don't care as long as you get the right answer, and more importantly, as long as you understand the concept. Now, that's cost of capital. Basically, what this means is, put it in very, very layman's terms. If I am borrowing money from you at 8%, I have to earn a little more than 8% to make any profit on that when I invest that money. It's as simple as that. What goes into calculating a firm? Now, like for example, there are several ways to calculate cost of capital. One of them is the security SML. That is, when the cost of equity can be calculated using risk-free rate plus beta multiplied by RM minus RF. That's another one. That's one way to do it. Now we'll also talk about here K astrope E and KE, which are slightly different from each other, because one of them is cost of retained earnings, which means you already have the money as a company. The other is cost of external common equity. That means issuing a new equity stock. All right. Now, this is where what they do is, I want to explain this formula to all of you once. This is exactly what we did when I did it with the weights in the second slide of this chapter, but I'm going to explain it. Weighted average cost of capital is the discount rate used in computing NPV of a project with average risk. Now, they're not talking about above average risk or below average risk, average risk. It is the hurdle rate used in conjunction with the IRR approach to project evaluation. Now, if you take a look at this, the weighted average cost of capital equals the equity portion of the market value divided by bonds plus equity plus preferred multiplied by cost of equity. Okay, then of course B plus E plus PF would be 100. So then you have the bonds portion divided by the total again. Now, only thing is, when you take the case of bonds, you always take it after tax. Now, why is that the case? Because interest on bonds is deductible as an expense when you write up your income statement. That's the reason why. Don't forget this concept. Can't even see here. The room is pretty dark. Let us see. Let me rephrase that whole thing. I can't see here. Okay. Now let me rewrite it. Do not forget. Now I can see. There you go. That only cost of debt is taken after tax. As you see here, KDE after tax, you call it. You take KD, you multiply it by 1 minus the tax rate. Then, of course, finally you have preferred divided by cost of preferred. See, this is the same thing as that. Equity fraction of capital structure multiplied by marginal cost of equity plus debt fraction marginal by marginal cost of debt preferred versus, so you combine all of them like I did in slide 2, you get the cost of capital. All right, moving on, we got a situation where I have to explain a few things to you about flotation costs, which is fun actually. First of all, always use market value weights. Book value weights don't matter that much. So this is an example. You can check it out like they did, like the one I did in the second slide. Essentially, they're doing the same thing here. They're taking the weights, target proportion. Now, this is another thing actually. That's if you have a target capital structure, that means the ideal capital structure that in your mind, use those weights because that's where you want to be. So you better start using it. Now, after tax cost, when they're talking about, only debt is being actually taken after tax here. Now, I want all of you to notice this. The proportion of debt is 51 and 8 multiplied by 1 minus 0.4. You see that? You don't see that in equity, or you don't see it in preferred, or this is equity. I think this is preferred. You don't see that in either place. The cost of capital of a firm is equal to the equilibrium rate of return demanded by investors in the capital markets for securities with that degree of risk. Like, for example, if you look at risk return for companies, securities, and all securities available in the market, essentially you start off with the risk-free rate, which is the rate that is paid on treasury securities of short-term duration, kind of like treasury bills. You start off with that, that is the risk-free rate. Then you come long-term government debt, then high-quality corporate debt, then high-quality preferred stock, then low-quality corporate debt, then common stock. Common stock being the riskiest has the highest expected return. I mean, you don't invest in treasury bills to get rich, do you? I mean, unless you're already very rich. Now, we get into the crux of this particular chapter. Now, what do I mean by the crux of this particular chapter? Let me use the green pen here. Green. All right. What is marginal cost? Marginal cost is the cost on the next dollar the company. It doesn't look like dollar, does it? Because it's all jumbled up there. I was trying to save space. I think I should not have done that. Dollar. The company raises. Now, marginal cost when it comes to debt is the cost that you will be paying on the next dollar of debt you raise, which is very important because when you're raising money, the cost, not overall cost, but the next dollar is very important because that's what people are expecting from you now, because then that's what you will be paying now. Now, pre-tax cost of debt is based on net proceeds of issuing new bonds. Now, if you look at this, this is just like calculating yield to maturity in chapter 6, I think that was bond valuation or fixed income securities. I want all of you to look at it. The right-hand side of the equation, which I'm going to highlight in yellow here, to calculate the before-tax cost of debt, there is no change at all. See this? There is no change at all. If you remember right, this is the coupon payment. Okay, let me use a pen here. This is the coupon payment. This is the cost of debt before tax. Present value of coupon payments on one side. I mean, on the first part of the equation, the present value of the future maturity amount on the other side. The only difference is instead of calling it PO, we are calling it P net. Now, why this difference? And I'm going to come to that right now. The difference is because of what are known as flotation costs. What are flotation costs? When you issue debt, let us say you are issuing debt for $1,000. Okay, you cannot just go out to the market and start selling debt, right? You need an underwriter, okay, who will place your debt. You need to advertise in newspapers. You need to approach people. And for all this, you need to file a lot of legal documents with the SEC. All this doesn't come cheap. All this costs money. If you're raising $100 million, that's a lot of money. SEC will go through all your documents and they'll come back with questions. And your lawyers will have to answer them. And believe me, when I talk about lawyers, we are talking about lawyers who work for investment banks here. They are not cheap. They charge by the hour and they charge a lot. And the advertising, the filing fees, all that. Let us say overall this company is paying $80 per bond that they are placing. So actually the company is only getting $920 in their hand, right? Because to sell for $1,000, you're paying $80. So your actual gain, from this transaction, actual incoming cash flow is only $920. And this $920 is called P net. That is proceeds net, you can call it, or price net. You can call it anything you want, as long as you call it P net. I would call it price net. Now, this 1,000 is PO. So essentially, by definition, PO is greater than P net or equal to. In case you're placing zero, that means there is no cost. Now, that will give you the cost of debt. Now, what does P net do for cost? It increases it slightly. Why? Think of it. This side, if it is 1,000, KD will be a little lower. You are dividing by KD, and yet, so instinctively it increases. If you think of it, you're paying for 1,000. What you're paying for 1,000, you're only getting 920. That means the cost has gone up. That's why KD here you calculate in this chapter could be a slightly higher. Now, KI is the after-tax cost of debt. And how is that calculated? KI is calculated as KD multiplied by 1 minus T. I told you all, debt, again I'm repeating. I think it sounds like an old, as my grandmother used to say it, an old gramophone record that is broken. It used to play the same thing, it seems. My grandparents had gramophone records. Debt is taken cost of debt after tax. Only one. All right. Now, in case a lot of times companies use these methods too, apparently, according to your textbook, pre-tax cost of debt can be estimated using the yield to maturity of outstanding bonds that a company have or sold by similar risk firms. But normally in my class, you will get a problem which expects you to calculate the pre-tax and the post-tax cost of debt. Okay, now, remember in chapter 6 you studied that KP is given by DP by PO. In case of preferred stock, here it is DP divided by P net. Again, P net is PO minus flotation costs. Like for example, they are placing the preferred stock for 100 and they tell you there is a 3% flotation cost on this. So actually P net would be 97 because it is 100 minus 3% of 100, which is 3, is 97. So basically flotation costs increase the cost of any source. Okay, now we come to the equity side of things. This is cool. This is really cool. Now, you all know that any earnings that have not been paid out as dividends belong to the equity stockholders. So, when it comes to cost of equity, you have two different types, internal or internal equity, or you can call it retained earnings. Now, The other one is external equity or new common stock issue. Now, these two are slightly different from each other. What is the difference? Well, think of it. Internal equity means the equity that you already have. You don't need to place it, you don't need to do anything, you just need to reinvest it. Okay? Therefore, only PO matters because you're not placing it and you don't have to register with SEC, you don't have to do anything. You already got the money. So, PO matters when it comes to internal equity. Whereas when you raise external equity, you got to have the same things you have with bonds and preferred stock. You have to register with the SEC, you have to place it, you have to advertise it. So, in external equity, you'll have P net instead of PO. That's the only difference, guys, really. Because when you sell new common stock, you again need to go through all the procedure that you need to go, that any public company needs to do to place their stock. So the cost of, because of the difference between PO and P net, the cost of internal, since PO is higher in value than P net, the cost of internal equity is less. This is a very important statement. Let me highlight in green. This is a very important. See that? Kind of cool when I think of it. I mean, all right. There you go. We already know this model, don't we? T1 by PO plus G. Normally, when you have something like this, we are talking about internal equity, because external equity will have P net here. This is one approach to calculating cost of equity. The other approach, of course, you all know the non-constant growth rate evaluation. We already did that. The other common approach, which you definitely will be seeing, is this. The required rate of return on equity, KJ, is given by risk-free rate multiplied by the beta of the firm and the market risk premium for all risky securities. And of course, you have to see it on the security market line. Now, remember, I mentioned a couple of slides ago that cost of internal equity was KE equals D1 by PO plus G. Now, let us just, since we have both of these, this is internal and this is of course external given here. Now, let me do something here. The only difference between these formulas, internal and external, is this. Now, let us say a firm has 30,000 in internal equity and the current market price of their stock, let us give it values. D1, let us say for this firm is $2. I want to go easy on myself. G is 5%. Okay. Now, let us say PO, the current market price is $25. And let us say if the firm places new stock, it will have flotation costs of say $2 per share. Now, you calculate internal equity differently, external equity differently. This will be 2 divided by 25 plus 5%, which is what? Two divided by 25 equals 8%. 8% plus 5%, let's write it down here. 8% plus 5% is 13%. Now, that will be cost of internal equity. Now, what will it do to the external equity? Now, KE, K astrope E, on the other hand, will be 2 divided by 25 minus 2, because $2 is flotation cost plus 5%. Now, what will that be? 2 divided by 23, because 25 minus 2 is 23, of course, is 9%. So this is 9% plus 5% is 14%. So because of flotation cost, don't forget this. See, that's simple. All right, y'all, you can take a look at this. Some divisions of a company may have higher or lower systematic risk, and that's possible. And each division could have its own beta or discount rate. Like, for example, if you look at a big company like General Motors, who have several lines, like they have the GM line, they have the Chevrolet line, they have the Cadillac line. Each could have their own way of doing things. So here are all the formulas given to you. Now I want all of you to notice these are the same formulas we used here. Like, for example, look at debt. That is the only thing they call after-tax cost of debt. You see this? The only thing that they use after-tax part of. No, I'm using the pen instead of the highlighter, which I plan to use. Okay, there you go. Okay. Where is it? Okay. Oh, come on. It's okay, that's finally working. Calculate KD, and then you take KD, KJ, KI, which is after-tax cost of debt. Then, of course, preferred stock here is preferred net of. Now, look at this. When it comes to internal common equity, this is exactly like what we did in Chapter 7. And, of course, this also. It's only external common equity where P net comes into picture. How do you calculate the overall weighted average cost of capital? It's simple. I mean, like most methods that are systematic, you just calculate each component cost and then compute the weighted average cost of capital. Now, what is breakpoints? As you take on more and more debt, what actually happens is the cost of equity goes up, the cost of debt goes up. It's just like this. If you have $200 on credit card debt and you pay it off every month, you probably are not paying any interest. But if you have $50,000 on credit card debt and you're paying minimum payments, you're paying probably a humongous amount in interest. So you got to understand that. And because of that, you need to understand that as a company, the same thing goes for a company. As a company borrows more and more, their cost of debt goes up and the risk of equity goes up, because of which cost of equity also goes up. Take a look at this. This is an excellent example of that. Initially, this company started off with 10.96 as a cost of capital. After some time, there is an increase in the cost of debt because they keep on issuing more debt. Then there is an increase in cost of equity because now the risk is higher. So their weighted average cost of capital keeps going up. What is the critical question then? Where do we stop? This is the question. Remember, we always come back to Chapter 1. What is good for our shareholders? What will maximize the value of their equity stock is what matters. Now, what is an optimal capital budget? I'm pretty sure I've taught about this on a regular basis. I'm pretty sure you're taught about this on a regular basis. What is the ideal scenario? That is optimal capital budget from a capital budgeting point of view. What is the ideal scenario? Ideal scenario is wherein you get to invest only in projects which return more than your cost of capital. And you'll be seeing this again later. Okay. Like, for example, take the case of the investment opportunity curve here. Now, let me use two highlighters here, green and red. Now, if you look at this, A returns that this company's cost of capital was 10.96, then 11.2, then 11.35. A, B, C, and D. They all return higher than your cost of capital. So you invest in all of them. Now, when it comes to E, by the time you get to E, which returns approximately around 11%, it returns less than your cost of capital. And it is because of that, you would say, I don't want to invest in E or F. So this is your ideal capital structure wherein you stop at 23 million and say, okay, that's it. Optimal capital budget is where you say, okay, this is where I'm stopping investing. I'm not going with projects E and F because here they return lower than our cost of capital. Let us do a few problems and then we'll be done with this. All right, we are coming here. Calculate the after-tax cost of 25 million debt issue Pullman Manufacturing is planning to raise privately at a large insurance company. The long-term issue will yield 9.375% to the insurance company. Now, I want all of you to understand this is a problem of calculation of after-tax cost of debt because they have already given the before-tax cost of debt. 9.375 is already been given. So this is given. So all you need to do is multiply it with 1 minus t to get after-tax cost. They gave you this problem, which is in page 445, just for one reason, to make sure you know the difference between after-tax cost of debt, which is to be used in cost of capital calculation, and before-tax cost of debt, which you studied in chapter 6. Remember, in cost of capital, you include after-tax cost of debt. Now, next problem. Husky Enterprises, problem 2. Husky Enterprises recently sold an issue of 10-year maturity bonds. The bonds were sold at a deep discount price of $615 each. After flotation costs, Husky received $604.50 each. The bonds have a $1,000 maturity value, which we always know and if pay 50% interest at the end of each year. Okay, now compute the after-tax cost of debt of these bonds if Husky's marginal tax rate is 40%. They have given us a lot of information here. Now remember one thing, the only difference between what you studied in chapter 6 and here is there you take PO when you calculate before tax cost of debt, or KD. Here you take P net. Your PO could be 615, but in this chapter what matters is the 604.50, which is P net. So when you plug it in to your calculator, this is how you plug it in. 604.50 is present value, 1000 is future value, 50 is PMT, 10 is N, and ask for I by Y. That will get you your before tax cost of debt, or KD. Let us do it, shall we? Okay, let me go clear my work. Second, clear work. I always love to do this. All right, 604.5 negative present value. Remember, this is P net, not PO. 1000 future value, 50 PMT, 10 is N, compute I by Y. You get 12%. So to calculate after-tax cost of, you have to take KD 1 minus T. This is my parenthesis is really okay. Let me go back here. KD 1 minus T. So you take 12 and multiply by 1 minus 0.4, that is multiplied with 0.6, 7.2. Now the advantage of KI, which you use in after-tax in the cost of capital, is see how much difference there is between KD and KI. That's because you can deduct interest as a deductible expense in your income statement, which you cannot do with dividends, remember. You cannot do that with dividends. Preferred stock and equity stock pay dividends, which are paid from after-tax profits. That's the reason why only debt is taken after tax. Cost of debt, that is. Kind of cool when you think of it. Problem 3. Problem 3 is about preferred stock. Calculate the after-tax cost. Now, sometimes in preferred stock problems like this one, they give you tax rate just to confuse you. Don't get confused because preferred dividends are paid from profit after tax. Calculate the after-tax cost of preferred stock for Bozeman Western Airlines, which is planning to sell 10 million of 650 cumulative preferred stock to the public at 50 a share. Issuance costs are 2 per share. So PO is 50, P net. PO is, we know, 50, but what matters is P net, which is 50 minus 2. So 650 divided by 48 gives you 13.54%. It's that simple. And ignore the tax rate because we are talking about preferred stock here, not debt. All right, let's get started on this. This is problem 4. Preferred stock, but is both a perpetuity and not a perpetuity. Now, St. Joe Trucking has sold an issue of $6 cumulative preferred stock to the public at a price of 60 per share. After issuance cost, St. Joe netted 57 per share. What is the cost? Well, 6 divided by 57. You all know that now, after the previous slide, that 57 is P net and not 60 was PO, whereas after flotation costs 57 is P net. Now, if the stock were callable in 5 years at 66 per share and investor expected to be called at that time, what is the after-tax cost of this preferred stock offering? See, they keep on talking about after-tax cost. They don't want to confuse you. Remember, except for debt, tax rate doesn't matter. Okay. Now, that aside, how do you calculate something like that? Now, look at it. We are talking about 5 years. So basically, this will be the cash flows from this 6, and 66. If they recall it in 5 years, this will be the cash flows from this. So essentially, what they're telling you is, we have a stream of annuity and a single payment at the end. Does this remind you of something? Doesn't this remind you of a before-tax cost of bond? Because that's what this is. So basically, you have a stream of annuity that pays 6% and 66 that comes at the end of 5 years. So how do you do this on a calculator? Essentially, it is done this way. Let me go here. Second, clear work. You calculate it like you calculate KD in chapter 6 because this is redeemable in 5 years. So we know the cash flows exactly. So 66 is future value. Okay. And you are getting now 57 for it, present value, 6 is PMT, 5 is N. Even though it's dividend, in this we are calculating it as a bond just to get I by Y, which is actually the rate of return. Compute I by Y, you get 12.96. Okay, now the 12.96 is not interest per year, but actually dividend per year in this case. Okay, it is the dividend yield, not dividend per year. Dividend per year is 6, but the dividend yield is 12.96. It's kind of cool when you think of it. All right, let's look at problem 7 in page 446. Now, I got to say something here to all of you. This is the starting of a couple of problems we'll be working on cost of capital. I mean, there you have to work several on overall cost of capital because in the exam I'll be giving you a problem like, say, problem 8. Where you will be you'll be required to calculate cost of debt, cost of equity, cost of preferred, and put it all together as cost of capital. If you get one of the first three wrong, you won't get the last one. So make sure you learn how to work problems like that. Now, Wentworth Industries is 100% equity financed. Its current beta is 0.9. The expected market rate of return and the risk is 14 and risk-free is 8. So the difference between market rate of return and risk-free rate, or the market risk premium, is actually given there. So you take the cost of equity, because there is no debt, there is no preferred, cost of equity equals cost of capital. So 0.9 multiplied by the market risk premium of 14 minus 8 plus 8%, which is the risk-free rate. The the cost of equity for this company is 13.4. Now this is assuming that this company is 100% equity financed, as they said. Now they want you to answer a question. They say if Wentworth changes its capital structure to 30% debt, it estimates that its beta will increase to 1.1. The after-tax cost of debt will be 7%. Should Wentworth make the capital structure change? The only answer to that is to see if the weighted average cost of capital comes down if you add debt. Now that means now you have to calculate a new cost of equity. Why? Because the beta has gone up. The beta going up means risk going up. So this company now has a beta, instead of 0.9, it has 1.1. Because of that, instead of 13.4, now you have a cost of equity of 14.6. Now, remember one thing though. We know that cost of equity will go up when you start issuing debt. But what we want to know is, will it reduce the weighted average cost of capital? So now you have 30% debt and 70% equity. So 30% debt and 70% equity means weight of equity multiplied by the new cost of equity, which is 14.6, plus 30% multiplied by after-tax cost of debt. Overall weighted average cost of capital has come down from 13.4 by less than 1% to 12.32. Actually, a little more than 1%. So actually, while cost of equity went up, WACC has come down, which is the whole point that companies actually issue debt. That's a very, very interesting problem. Now we come to probably the most important concept. Now this is problem 8. Calculation of component costs and of cost of capital. Now, in addition to what you see here, what that I'll be doing, I'll also send you all a worksheet. Problems that I want all of you to work on. Okay, that will have both capital budgeting and cost of capital. I want all of you to work on those because exam questions are a little kind of like this one. So I want you to work on that. Let's look at this. Problem 8. The Ewing Distribution Company is planning a 100 million expansion of its chain of discount rate stations to several neighboring states. The expansion will be financed in part with debt issued with a coupon interest rate of 15%. The bonds have a 10-year maturity and a $1,000 face value, and they will be sold to net Ewing $990 after issue cost. That means basically they're telling you that $990 is P net. Ewing's marginal tax rate is 40%. So the first thing you write down all the stuff that you got here. Okay, let me write it down here in notes. Now we know the expansion is 100 million. Okay, now we know, what else do we know? Let's look at the debt. The expansion will be financed in part with debt issued with a coupon rate of 15%. Coupon rate of 15% means we know that PMT is 150. Okay, 150. Now what else do we know? The bonds have a 10-year maturity and 1,000 face value. N is 10. Future value is 1,000. And they'll be sold to net Ewing 990 after preferred cost. So 990 means present value, or in this case P net is minus 990. Ewing's marginal tax rate is 40%. So first we need to calculate before tax cost of debt, or what is known as KD. And how do we do that? It's actually very simple. Let's go to second clear work. Okay, 150 is PMT. 10 is N. 1,000 future value. 990 is present value. Compute I by Y, 15.2. As I said, we get 15.2 by calculator. So that is before tax cost of debt. Now you all know that you need to calculate after tax cost of debt to include in cost of capital. That is 15.2, and they told you the last sentence of the first paragraph, Ewing's marginal tax rate is 40%. So essentially all you have to do is take 15.2 multiplied with 1 minus 0.4. So after tax cost of debt, such as it is 9.1. That's the one that matters. Okay. Preferred stock will cost Ewing 14% after taxes. Well, they gave us preferred. We don't need to calculate it. So we got cost of debt. After tax, we got preferred stock. Now, Ewing's common stock pays a dividend of 2 per share. That means we are told, now we are coming to equity stock. We took care of preferred, we took care of debt. DO is 2. The current market price is 15. So PO is 15. And new shares can be sold to net Ewing 14 per share. P net is 14. They're giving us a lot of details here. Ewing's dividends are expected to increase at the rate of 5% for the foreseeable future. So G is 5%. So D1 will be DO multiplied by 1 plus G, which is what? 2.1? Is that it? 2 multiplied by 1.05. I think it's 2.1. Yeah, there you go. Now, we took care of that. 2.1. That's done. So now we need to, Ewing expects to have 20 million in retained earnings available to finance the expansion. And they give you that target capital structure. Okay, first of all, let us find out cost of internal equity and external equity before we worry about the finance structure. What is cost of internal equity? Cost of internal equity, which we all know, KE is D1 by PO plus G, which is 2.1 divided by 15 plus 5%, which comes to here. Let me highlight it with a different color. There you go. I love these highlighters and the pen color changes, makes it easy for me to explain. Now, as opposed to internal equity, this is internal equity. What is new stock financing? What does that mean? Now, that is a different thing altogether. That is K astrope E, which is D1 by P net, not PO, but P net plus G, which is, of course, 2.1 divided by not 15 anymore, but 14 plus 5%, which is 20%, which I'll use another different color to let's use red. See this? The difference comes because here and oh, that's got to be kidding me. Okay. The difference is because here it is 15 and here it is 14. Now, we took out KD after tax, that is KI. We took care of KP, that is given to us in cost of internal equity, which is KE, and K astrope E, which is external equity. We know all that. To calculate weighted average cost of capital, we need the costs of each source. We took care of that. Now, we need to know what are the weights of each source. Now, let's take a look at this. They have given us their target capital structure. Okay, debt 20%, preferred 5%, common equity 75%. Now, how do you know? So, for one thing, we know that the weight of debt. Okay, the weight of debt has been given to us. Now, let me use let me go with my favorite color here to highlight. Okay. Oh, it's come back to red. Okay, fine. Let's go with this. Okay, because I want it to be different. We know the weight of debt is 20%. Okay, because they told us there in the target capital structure. We know the weight of preferred is 5%. And of course, you all know the after-tax cost of debt is 9.1. The cost of preferred is 14. You know that. Now, we come to internal equity and external equity. How did we know that together equity is 75%, as they mentioned in that small table there where they say common equity is 75? How do we know only 20 million of that is internal and 55 is external? It is simple. You'll use the cheaper source as much as you can. Now, if you look at the last sentence in the second paragraph there, they say Ewing expects to have 20 million of retained earnings available to finance the expansion. Now, you know this thing, right? Total equity has to be 75 million because we have 20 million internal equity available. That means external is the costlier one. Whatever we cannot raise internally, we use external, which is 75 minus 20 equals 55. That's how they got the $55 million here. The weight of that. Actually, let me do this. I'll remove the highlight because I've already highlighted it in a different color because when I made these PowerPoints, I did not know I'd have all this. Now you have all the components. So you multiply each of the component with 0.2 multiplied by 9.1 plus 0.05 multiplied by 14, 0.2 multiplied by 19 plus 55%, 0.55 multiplied by 20, 17.3. That's how you calculate weighted average cost of capital. You have to see, remember one thing, to get this whole thing right, you need to get each of these right. So practice, when you're tired, practice a little more. That finishes this chapter, and I'll talk to you all again in the next chapter. Have a great day.